What up, chat? It's that time again. It's the Higher Standard, baby. I'm your host, Chris. Welcome back to the party. For those of you new to the show, we try to look at the market, try to give you everything that CNBC gives you in approximately 8 hours of the day less than that. The show is awkwardly timed at 11 a.m., although we are starting 10 minutes late today, going to about noon for the reason that we give you kind of an inter-day market look while giving you enough time to make whatever decisions you want to make while the day before the market closes at 1 p.m. Pacific Standard Time or 4 p.m. East Coast Time. This show is brought to you lovingly by the team over at Fridays. You go to joinfridays.com, enter code HIGHER, and you get $100 off your first order. Everything from micro dosing to actual GLP-1 use, as well as NADs and longevity medication. I'm a big fan. And if you've been following the show for a prolonged period of time, you also know that the last episode, which dropped yesterday, episode 329, we talked a lot about companies in that space trying to disrupt it, but not having the same care as our team over at Friday. So go to joinfridays.com, enter the code HIGHER. You will get hooked up if you use our code. This has been a tumultuous market, and I am not going to sit here and tell you that any of this is expected. We running models that we've been sharing with you. I've been giving you kind of insights and thoughts into what I think the economy is going to do. And, well, I mean, it's just bizarre. It's nuts. You got CPI, which came out today, and it showed, not the actual CPI number, that'll be out on Friday, but we had a CPI print, I want to say, from the BLS today. I'll take a look at it with you a little bit later on. But that CPI print seemed to suggest that there was some stress and that it will come in hotter, which should bring the treasuries down as a result of that. But I'm not actually seeing that. The market's seemingly rallying on the stock market side, largely because of the ceasefire talks with Iran, which we're going to get into later on in the show, is dominating the social rhetoric. And look, you could argue a compelling case on the other side that, look, these companies in the stock market have gotten hit pretty hard. You got multiples that are down, and you got profits that are up. There's no reason why the market should be down. I am not in that camp. I am in the camp that we need a correction. I think we're overvalued in a lot of places, particularly the housing market, where I continue to see affordability be an issue that's problematic for all of us. But before any of that, welcome, friends. Welcome to the show. I am standing today because I don't really feel as energetic and as gassed up as whenever I do it on the non-standing show. What up, Big Vic? How you doing, brother? And let's see what we got here. I got Saied in the chat. All my friends, hello and goodbye. That's sad. Can Pop, yes, we got one. Sean, yesterday's podcast got me motivated to see if I can vibe code to an AI agent. Yeah, man. Let's spend a second talking about that, shall we? It is crazy to me. The more I think about that company Medvy that we talked about on yesterday's podcast, the more I'm like, Jesus, man, like there are so many opportunities in this space right now to kind of disrupt things and make a whole ton of money. It's kind of striking. Now, I don't think Medvy is the best example because of some of the turmoil around them, but it really goes to show you what they can do with just a little bit of time, a year and a half, and you're making tens of millions of dollars. That's crazy. The TBPN thing, I was actually wrong on the show. I read this morning it's closer to 200 million they sold that thing for versus 100 million. Big difference. So, yeah, look, the world is your oyster right now. As much as it's easy to focus on the loss of jobs, the headlines, the sensationalism, there is such a huge opportunity to create. And I want to be clear, creating in this environment isn't the same as I built a business, blah, 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 blah. It's any business in the world can be changed dynamically if you understand AI and some of the tools that go behind it. So I don't think there should be as much of a negative connotation as an opportunity finding connotation of what's going on right now. And that my stance on that has changed because I've seen how powerful some of these tools are. One of our listeners, Matt, who's been on the show, he put out an app in literally a couple of days called Alibi, which I thought was strange and cool and awesome all at the same time. So when he actually deploys that app that he built entirely with vibe coding and AI after taking some of the courses online and spending some time getting close to it, I can tell you that it not only is it happening, but people are literally putting out products that get to the App Store, for example, in just a couple of days. And the whole hang up is how quickly can Apple approve this stuff and push it out. It's really, really fascinating stuff. If you're watching the ticker, our real-time ticker down here, everything is looking really green today, kids. So just know that going into it, we're seeing some pretty positive momentum and some pretty wild stuff going on in the market, not all of which I've got good explanations for. So market status, as you probably is going to expect, is that we are in a broad rally. It's a bull market, 2% up on the Dow, 2% up on the S&P, 2% up on the NASDAQ, Russell's up, QQQ's up, everybody's up. 3% for those last three or more. It seems to be a sensational broad rally for reasons that are just really rhetoric based. And that to me is very unsettling, right? Like you have headlines that are coming out. Yesterday it was going to be like the obliteration of a country off the map by 5 p.m. East Coast time. Or no, I'm sorry, 5 p.m. Pacific time, 8 p.m. East Coast time. And then we got this 2-week extension, and now you got narrative around negotiations, but yet there were some bombings overnight on the Saudi pipeline, and I think there was some stuff in Israel as well. So who knows? But the market rallies off this, and it's just the strangest thing because in my history, we've not seen this level of volatility. And some of it's just information flow. You got social media, you got stuff like me, like this out there that's just broadcasting. The headlines get more and more extreme to pull you in. So I guess it should come as no surprise that extreme volatility in the market is kind of the new norm. But I mean, just last couple days has been kind of a slow, grim day. I mean, you saw me on Monday. It wasn't a very happy, optimistic dude. And now I'm looking at this going, what the shit? And of course, where's my synthetic volatility index? What's going on there? Did somebody break it? Let's see here. My risk chart. Let me try to refresh that real quick. Oh, there it is. That was strange. Is it not working? There it is. Okay, well, that's strange. Well, there's our synthetic volatility index. We're showing the market at tense realized volatility. A little bit unstable on the realized volatility, but intraday stress is normal. Implied volatility is calm 100% because the entire market is rallying, right? Cross-market volatility, all of them are rallying. There's not one that's rallying more than the other one. And synthetic volatility score of 55, it shows us that we're still in a bit of a tense place, largely because the VIX in and of itself is still north of 20. So there still is some volatility and some fear in the market. But that being said, we're still rallying. And that's kind of the confusion here when you start thinking about the market and what's going on is like, on one hand, we're afraid. I mean, we came down from a VIX of 25. So we are seeing an improvement in the overall perspective as it relates to fear. But I want to be clear that we are also seeing some pretty palpable, decreases, down 4.93% on the VIX today. That is a pretty meaningful drop off right there. That is the fear gauge falling in line. Let's look at the 1-day number, and it's going to look like a pretty. Actually, let's look at 5 days. There you go. That's a pretty big drop right there, right? That's fear coming straight down. People going right back into the markets, and that's going to stay elevated. I think above 20, maybe 19 for the rest of the day. So you're going to see some very different perspectives as it relates to the market today. That's our synthetic volatility index. Let's go to liquidity pulse. This is the Fed's balance sheet. The Fed minutes came out today. It was somewhat breaking news. Everybody except Myron, who was the president's pick to put in the FOMC panel, who's been very, very hawkish and aggressive on the idea of needing more rate cuts. Everybody but him thought we should hold rates because geopolitical conflict, the war in Iran, and a lot of this controversy, including the tariffs for that matter, have caused stress on both sides of the Fed's mandate, both jobs and stable prices. I would expect to see them, my guess based on what we're seeing right now, is a hold, and that we're going to see them hold rates until about the end of the year, at which time they're likely to increase the Fed funds rate. That would be my guess based on what I've been seeing so far. But don't take my humble opinion for it. I am nobody in this perspective. Let's go to the Fed Watch tool and see what the Chicago Mercantile Exchange is saying here. That is a 99.5% probability of holding rates where they are, okay, at the next meeting, April 29th. Versus a 0.5% probability of an increase, not a decrease. So we've seen a very palpable shift in prior versions of this. You saw the bar over here at keeping the rates the same and decreased probabilities, but certainly that has changed a great deal. So we're not going to see a rate cut at the next meeting. And if anything, you're looking at a prolonged period of no rate cuts based on what the Fed minutes said today. So expect that to be where we're at now. That doesn't mean the treasuries aren't going to move. That doesn't mean mortgage rates aren't going to move. You're going to continue to see those move. And what's interesting and what's happening on the mortgage rate side is that you're seeing the long end of the curve come down a little bit the last couple of days. I haven't checked today yet. We can check that here momentarily. And you're seeing mortgage rates kind of stabilize into the mid sixes from getting almost up to 7% again, which I thought was equally as fascinating. The market is responding in ways that don't make any sense to me, but you know what? That's okay. It's just a brave new world. This is the 10-year Treasury, closest proxy to the 30-year mortgage rate you're going to see. This is at 4.289, just down about 56 basis points or so. So that's a pretty decent drop from where it was in the 440 range earlier in the, I want to say, the week of the month. So we're seeing some improvement on mortgage rates. Now the spread over the Treasury. Used to be kind of closer to 2%. Now we're seeing it somewhere around 180 to 225, depending on who's quoting you and what your credit criteria is. So you can expect mortgage rates to be somewhere in around the 6.4-ish range on a 30-year fixed mortgage as of today, using this, of course, as a proxy for the bigger picture. Jumping into that, straight into the home affordability section of today, we are seeing stretched mortgage affordability still. There has been not any meaningful change here. Again, supply is still not the biggest issue. It's rates and home prices. People hate that. Rates being the easiest to move, home prices need some time to take, but we are seeing some improvements there. The calendar section, the biggest thing to note as of right now is what comes out on Friday of this week, and that is going to be, where are we at here? Blah, blah, blah. There we go. Core inflation and inflation in general on Friday. That is the data to watch. That is what's coming forward. That, if you're going to watch anything this week, that's the one. There's jobless claims tomorrow, but for me, it's all about Friday's inflation. I expect that to come in hot and much hotter than people expect. As a matter of fact, the inflation data we got today seems to suggest that is absolutely the case. So expect that to be what we see. So let's go over to Instagram. How are you, friends? What up? Thank you for those of you joining. What up, Max? How you doing out there, buddy? I know I owe you a response to an email. I've been a little bit bogged down with some stuff. I will get to it. I promise. I have not forgotten. And for those of you over on YouTube, yo, Saied, you still out there? You watching? You giving us 5 stars? You still doing the thing? LinkedIn, some comments here. The comments on LinkedIn are always more technical. It's strange. But anyway, all good. All good. So I guess we should get into the market and get into some of the analytics here. I'm going to go over some of the XAI stuff here in a minute. But I'm going to be clear here that a lot of what we're seeing in the markets is tumultuous, right? And you got to separate your political beliefs from the overall consensus of what needs to happen from a fiscal perspective, if that makes sense. So we're going to talk a lot about the headlines and the narrow rallying, but you got to again focus in on what we're trying to really focus on here, and that's the business side of this. Divorce yourself from the emotions to the extent that you can, because this is strictly an economics conversation at this particular point in time. We do have a sensational podcast coming out tomorrow if you like a little bit more of a political slant, because we thought it was an important and a value add to you, our guests. So look out for a special drop tomorrow of the higher standard. That'll be streaming on all podcast platforms and on video. Let's get into XAI. Oh my God, what a shock. The Iran-Israel ceasefire deal, major breakthrough in the Iran-Israel negotiations with ceasefire agreement reached, though Israel reportedly wasn't consulted, and tensions remain over implementation terms. And that's a strange set of circumstances, but this is resounding optimism that's driving the markets. While ceasefire news is driving relief rallies, i.e. this, there are problems with that position. The exclusion of Israel from the negotiations suggests fragile implementation and potential reversal risks. And I think that's not something that people are really considering in the right way at this particular juncture in time. This, to me, looks like a very strange set of circumstances and facts that aren't necessarily aligned with what should be a conclusive market rally. So it would not surprise me if additional detail came out tomorrow, which made people go, shit, it's not as certain as we thought. But everybody's trying to capture that last bit of profit in additional information that's coming through. And I get it. That's what happens, right? Hormuz Strait closure. This one's fascinating, okay? So I'm going to read what it says here, and then I'm going to tell you what I heard on CNBC and some of the local news that I looked up before this. So Hormuz closure historically creates short-term oil price spikes, but markets may be pricing in temporary disruption given the concurrent ceasefire. This, of course, because the Strait of Hormuz, Iran has stopped tanker passage through the Strait of Hormuz, creating major supply disruption and concerns. Okay, only 2 tankers have gone through the Strait of Hormuz, I want to say in the last 24 hours. Both of those contain dry goods. If you look at a map of the Strait of Hormuz, there is no oil tankers going through. As a matter of fact, one of the largest, if not the largest, oil tanker company that runs through there just put out a statement right before I went live today, which is why I was late, effectively saying they have yet to get a comfort level going through the Strait of Hormuz. So there's that. And Caroline Leavitt, who was the White House press secretary, was also watching that, watching too many things at the same time. And she was saying in the White House brief that she just had a couple moments ago that the president wants there to be no other terms. So being able to tax shipments going through the Strait of Hormuz, as we recently heard Iran saying that they wanted to do, is not seemingly on the table. So if that is not on the table and that's the last position they had, I don't know what position we're really in from a negotiation standpoint. Objectively speaking, it sounds pretty far apart from my perspective, but we will see. Meta AI breakthrough. This was fascinating. I got this at the gym this morning. Meta stock surges over 8%, which they needed. They were down a little bit on a lot of the innovation plays they made early on. The virtual world, for example, it was effectively shut down. Tens of millions, if not billions of dollars had been wasted on products that had not delivered to the market because they were trying to stay innovative. I respect it, but at the same time, they needed a win. Well, today, after announcing their first AI model from its super intelligence group, I want to be part of that group. Hey, Chris, what do you do for a living? I'm part of the super intelligence group. Anyway, marking significant advancements in AI capabilities. This is supposed to be a challenger to the AI space. It's their LLM, if you will. Meta's AI announcement validates heavy R&D spending, but real revenue impact depends on monetization execution versus current leaders, OpenAI and Google. I would also throw Anthropic in there, but I think if you're looking by just revenue, then yeah, probably Gemini is doing a little bit better on the adoption side. AI agent revenue surge, ironically, a very transitional topic, a very good segue, if you will, until I fuck it up. All right, Perplexity's revenue model, Google, jumped 50% in 1 month after shifting to AI agents, with ARR reaching 450 million, highlighting the rapid growth of AI agent market. Wow, yeah, and you're going to see this. I think we talked about this in the show for a number of times. I think this is important differentiation to make here. You are going to see these LLM companies, learning language model companies, where you go to and you get basically the Google prompt, where we've adopted this Google search engine type mentality, shift from that focus, and that's going to still be there, but all the way into agentic AI, because agentic AI is something that's supposed to think for you and anticipate your requests. It has a history of your knowledge base. It'll still be the same platforms. It'll still function with the bar the same way you're seeing it, but their primary focus will be to integrate into different parts of your life. And as it integrates into different parts of your life, you're going to get more of an agentic feeling. And then we'll eventually, maybe that's months, maybe that's years, we're going to grow into in artificial general intelligence. Before I dove into AI, I thought AGI, artificial general intelligence, was really on the horizon. And I've seen some very notable people talk about it coming out as early as possibly the end of this year, maybe the beginning of 2027. And I would say, based on my experience so far and what I'm getting with my agentic AI and my Mac Mini, I don't think that's true. I think we're much farther out than most people realize, at least from a consumer perspective. There might be some company that has much more compute and GPUs and CPUs and all that stuff that has the ability to do so. But look, great for tasks, great for admin work, sensational if you need someone to manage your calendar, manage your activities, and do things for you from a task-based function. But when you try to tie it all together, I'll give you a great example of what we're struggling with here. I've got a model. It layers in all these different things. You know what? Fuck it. I'll show it to you. Hold on a second. You ready? Let's go. I'll pull up the alpha. I'm going to drag it over to my share window for you kids. All right, what I'm going to show you is, again, what I've showed you in part, but I'm going to explain what's broken so you understand the hesitation here. This is our AI agentic trading model, also being known as Black Crown Alpha. This is sensational for me because it allows me to run several different models. Matter of fact, 16 different strategies all against each other, Monte Carlo analysis. We have a section up here, go, no-go readiness. Down here, we have a machine learning data section. We're not there yet, but I've got effectively cloud GPU on standby, ready to rent once I get data enough, built up enough to get machine learning on board. And there are effectively 3 different phases to machine learning rollout where it'll effectively teach itself. I can't wait for that day because I'm tired of spending money on API calls trying to fix this. This is the current total portfolio balance. Some of this is paper trading, some of this is not. All right, it tells you the current unrealized losses. This is betting on 2 different philosophies, trying to show me which one is more profitable. So I did expect to have losses in this phase. This does not mean our models are not profitable. This just means our models are not effectively working with all models in symmetry, which is fine because if you've got the prediction markets one, which works well, and you've got the paper trading options one, which doesn't work well, all good. We just need to know what works. And again, I would ask to give a big ass asterisk on this and just say, crazy is probably the best way to put it. That's the market we're in. So I am testing this in the utmost volatile market we've experienced in a long period of time. I like that as a guy who's developing it, but it also makes these results very unpredictable on some level, and that's fine. I'm going to show you how we're handling that. This shows you the regime summary. We expect inflation to come in hotter. Risk appetite is narrowing, and markets are efficient still, which is kind of wild and nuts. System status, don't worry about it. Philosophy check. Of the philosophies that I have here that are built into this, including Ray Dalio and some of the Soros, a lot of the major hedge funds, this aligns the framework and explains to me what might be connected and what might be disconnected in the model. Right now, there is not 100% alignment from any one of the philosophies for trading. We have partial alignment, macro regime, accelerating growth with strengthening labor supports risk on positioning, but narrow risk appetite and unknown liquidity create structural headwinds that conflict with a 98% market conviction. How can the market be so convicted and so much in believing so much that this is the current status today when we're seeing inflation numbers come out that seem to suggest that the cost of living is going to increase and the Fed's job is going to be under pressure? Those are disconnected. Now that, if you watch the show, is what we try to teach you. That is the macro edge. That is the disconnect between the data and the behavioral economics. And those two disconnects create opportunities. You just have to know how to exploit them and how to take advantage of those opportunities. This model is searching for that delta, that alpha. So here's how this plays out, right? And I'm gonna do this on a sexier view and I'll come back to it, right? So technically speaking, if CPI comes in hotter, right? Comes in hot. We know that's going to happen. We know it's probable. We know it's likely if it comes in hotter. If it does come in hotter, that should, in theory, take the treasuries, and I'm looking at the TLT, the long-term treasury, I think it's 20-year, and that should bring the treasuries down, right? Bringing mortgage rates down, bringing a lot of the market down. Because if CPI comes in hotter, the long-term treasury comes down as a natural behavioral byproduct of that in most markets, and I'm using the word most here because volatile. This is your options play if you expect this to happen on Friday. This is a big test moment for our system and what we're trying to validate, because it tells me if the markets are going to behave rationally, right? These are the normal things that should happen from a mathematical perspective. This is what all the shit the trolls talk about and talk shit on online is. Well, you didn't know about the economics of the course, man. And I'm like, hey, man, behavioral economics behave differently. We've democratized space as retail investors. They can drive GameStop stuff up. You can't ignore their impact. So what we're trying to do is see if rational behavior is still built into the pipeline of the mechanics, the underlying fundamentals of the market. If in this crazy-ass volatile market with this crazy-ass social media rhetoric and all the stuff that we're looking at still works the way that it should, our model will be validated and we'll feel very good about moving on to the next phase of trials for it. But back to the phase of trials, let me show you the sexy stuff, okay? This is the model regime. We talked about it here. This gives you your pipeline uptime, purple holidays. These green blocks tell me that all the data that's supposed to come in, there's supposed to be 5 data draws as we get near to certain inflationary trends, but this shows me that 3 minimum came in, usually 7 a.m. pre-market, 12 p.m. market open, 4:30 market close, just to let me kind of know what the data looks like. This will all be moving in real time eventually and give me uptime based on that. The go, no-go process, I've got 2 of 11 go, no-go for real live cash trading to happen. We are not there yet, hence the reason why we're still going through the data perspective. Risk limits, these are only 2 of several different theories. This is a Polymarket's Kalshi prediction markets wager machine and an options book machine. Although I am thinking about switching from one options book to another. I'm currently on Alpaca, but there's a couple different others that came out with some really interesting data points. And to me, data sells me. One of them has an agentic AI feature, which I really like a lot. Okay, this is your unrealized gains and losses. Purple is your options market. Green is your predictions market. And the gray line is the combine of the two, which is why it's lower here. This is my activity blotter, which basically tells me everything that the AI is doing behind the scenes. One of the problems that I have flagged in doing this is I have to make sure that I know what the AI is doing. Even though it's autonomous, you still got to have some oversight. Think of this as an employee, right? If an employee works for you, you want to make sure that you check in and go, hey, Billy, what are you up to, bro? What's your work product? And yeah, you can look at Billy's total overall, benefit to the company, but sometimes you want to see the nuances of what Billy's been doing so you can gauge Billy, coach Billy, work with Billy, and collaborate on growing together. Well, that's what this is. It gives me some insight into what Billy, our AI here, is doing. Prediction market book on the left, options book on the right. Of course, the devil's advocate mode, this bar down here, and the philosophies that are underneath it, which I know you can't see well, tells us the opposite perspective of whatever AI is doing. If AI says, hey, we're going to make this trade, Chris, devil's advocate tells us why we should not make this trade, right? It's playing the devil's advocate on this, saying, hey, I know you want to make this trade, but let me tell you what can go wrong. Let me tell you what's fucked up. That's what this does. Gives us a score individually at each one of the trades. Also gives us an overall regime map here on this. Options intelligence. I'm still building this out a little bit, but basically gives me devil's advocate pricing over here. Gives me the IV rank. Gives me the IVs for all the options trade, including the Greeks, delta, theta, et cetera, gamma, all those fun stuffs to decay. Hypothetical balances combined. This also gives me no-go bar, Fed policy, labor market inflation, other factor, risk allocation. All that's cute. But this is where we really get sexy. And I know I'm boring some of you out there. I apologize. We'll get back to the sexier part of the show in a bit here. I got some regime play, some model stuff, but let me show you the stuff that I built the last couple days. Number one, this is our media intelligence. This is pulling media in from a lot of different sources. We pay a lot of money for this. I can click on any one of these articles. It'll take me to the article. It gives me the headlines. Obviously, you got some red, you got some green. One's bullish, one's bearish. Right? Lets me know. It tells me if monetary policy, macro policy, fiscal policy in the markets, are they neutral? Are they leaning bullish? Are we in the bullish space? What's going on? Obviously, there's a bit of a disconnect here because we're seeing a very bullish market, but we're seeing a media, the sentiment that doesn't seem to be as bullish. But it said yesterday some fascinating stuff. This here shows the curve, okay? All these greens mean that the treasuries from the 1 month all the way to the 10-year are coming down, while the other ones, the 20-year and the 30-year, are going up, which is fascinating, right? So these are all going up. This actually leans into our inflation model because if inflation comes out Friday, it comes in hotter. I would expect these two over here to come down, and that's what we're betting on in the markets. That's our first real paper trade. Here you have SEC Edgar filings, all the public filings from large companies. RAI looks at it, it pulls the information in, lets us know what their positions are, lets us know what their strategies are. This happens both quarterly and any incremental filings that they make in real time. And if I want to, I can just click on any one of these here. I'll pick one at random. Where did you go? Actually, wait a minute. Where did it go? It used to have a little detail here, but doesn't have that anymore. It's fine. Down here, this is the sexiest part. All of the major hedge funds, Bridgewater, Citadel, Point72, Renaissance, tells us what they're doing for inflation, for financials, or their calls or puts are, lets us know what all of their positions are relative to their current portfolios, gives me a quarter after quarter look. It's only done 1 quarter so far, but it builds trend lines on every single one of them so I can see where the major hedge funds are putting their money in real time as they file as well. So then obviously down here we have a calendar which tells us exactly what's going on, and in the very bottom a data integrity section which lets me know if anything that we're using from a data perspective might be delayed. So the commitment of the traders and the BLS is cached. Everything else is brand new live data. And the reason why some of those prints that come from those places aren't exactly daily anyway. So, meh. So we built all this into a very, very aggressive media machine. There are still some nuances, still takes some work to get done, but that is where we're at from a media perspective. And that's why so much of what you're seeing on the show matters, because it's all built into this algorithm. Now, tying it all together is a fucking nightmare. Let me be honest with you. It's not easy to do. All right, I will pause. I've been rambling a lot on the comments. I haven't even gotten to the sectors yet. What are your thoughts, kids? Are we going to have a full week of the higher standard? Well, yeah, you are, brother. You're going to have a full week of the higher standard. And by full week, I mean you get Monday live, Wednesday live, Friday live, Tuesday show, and a Thursday show this week. That was always the dream. As moist as that dream may have been, it's hard to do. It takes a lot of implementation and infrastructure on our parts. And the live shows, I try to be a little bit more liberal with. If something comes up, life gets in the way, we take advantage of that life. But certainly, we try to take a little bit of joy in life in not being tied to the desk as much. But an hour is not a lot to commit for a live show like this, which I don't have to edit. Now, what pisses me off to no end, my friend, is the way that YouTube treats our algorithm for the lives. I almost want to say F the algorithm and keep them on so that we have a consistency of live shows that are out there. But the algorithm doesn't reward that. But then I just saw TBPN, which is an entirely live and only live show, do their thing. So that's frustrating too. What I'd like to do is live call-ins to this segment where we have like a narrow, like 10, 15-minute discussion with somebody and do that. But yes, you're going to get a whole, full, big, sexy week of Chris and Saied. Mostly Chris, a little side of Saied on Tuesday and Thursday. Actually, Saied is not on the Thursday episode. He was there, but it's Farshad who co-hosted that one with me. So you won't get a full dosage of Saied this week. I apologize on his behalf. Sometimes you just need, a little less sexy than you need, in other places. Let's see what's going on Instagram. What's going on? Zach, how you doing, brother? I see you little stalker. Trevor, how you doing, brother? Anyway, okay, let's get back into the XAI, and we'll go to the sectors, because I do want to cover the sectors in a bit of a different order today. I think the XAI stuff is fascinating. So let's go into the rest of the headlines. There's more market breadth strength. Over 82% of the S&P 500 stocks trading above the 5-day moving average, showing stronger short-term breadth since November, despite geopolitical tensions, right? The market's saying, fuck it. That's what they're saying. Again, I'm paraphrasing. Strong breath during geopolitical uncertainty suggests institutional buying confidence, but historically precedes consolidation phases after rapid advances. And that's what scares me the most, and AI's catching on it here, is I'm worried about market consolidation because we've rapidly advanced so much with, effectively revolutionary technology and AI. Either that narrative comes true and AI gets real disruptive, real quick, in a more meaningful way than it already has, or it could be looked at as NFTs. I mean, I'm not going to say that extreme, but certainly close to it, right? Cash rotation acceleration. Investors rotating the cash at one of the fastest paces in history, suggesting defensive positioning despite recent market gains. This is AI reading headlines from social media, and yet, you ready for it? The fuck? Market's in a broad rally, baby. Somebody's putting that cash to work. So, what? And this is the confusing part about the markets. This is what makes no fucking sense, right? No sense. Well, yeah, all my housing pundits. RIP, homie. Prayers up. Purchase applications down 7% year over year in the first negative print of the year, with mortgage rates' impact on housing demand becoming evident. Or people like yours truly have been sounding this alarm for years. So, I know. People on the other side are going to say, broken clock is right twice a day, Chris. Yeah, fuck off. All right, first negative housing data print suggests rate sensitivity is finally impacting demand, potentially pressuring the Fed to consider more dovish stance. And we got that today. The Fed's headlines exactly suggested that, right? And it wasn't because of housing. It was because the geopolitical conflict is affecting both sides of their dual mandate, jobs and stable prices. Since both those are not seen to be in line, inflation likely to come in higher on Friday, jobs can be at 4.3%. Why would they cut? What is the motivation? Seemingly none. So that's a problem. Let's get into the sectors. Yeah? Well, it should come as no surprise. What the hell with my, why is that like that? Let me see if my sector chart needs just a little bit of love here. Let's rotate this a little bit. Why? The logo thing pisses me off because, we spent so much time doing the logos here. JP Morgan, Wells Fargo, housing. Come on, housing. There we go. I'm getting like weird. Is it like one of the moon things? Everybody's like the full moon nonsense that everybody's like, my technology's doing some weird shit today. Okay. DR Horton is up 4.2%. Lennar, Pulte Group, Toll Brothers, and NVR. All the housing guys are up because we've seen some incremental improvement, but they're just caught up in the broad market rally. We're still here, kids. So everything's going to get a little bit of a oomph, if you will. Yeah, I made the hip thrust section that you couldn't see on the table. Banks are going to be popping. What's good? 3% across the board. Goldman Sachs and Citi, 4 and 5%, knocking it out the fucking park. If you took a bet on something yesterday and you're like, oh, let's just see what the market does. Hey, you're cashing checks today, man. Commercial real estate and REITs. Not as much as the rest, but pretty good. Oh, U.S. has violated ceasefire agreement. Iran parliamentary speaker says. I'm gonna. I'm mid-show. This is crazy, man. I'm mid-show talking about a market rally, getting into the sectors, being all chippy and optimistic and stuff, and I'm like, the market's trading off this idea of a ceasefire, and literally in the middle of a positive trading day, the U.S. has violated ceasefire agreement. Iranian parliament speaker says. This is an article. Fuck it. Here we are. This is breaking news. Please refresh for updates. This is literally 1 minute ago. God, man. Come on, meow. Is this going to have an impact? Well, we got about 20 minutes left of the show. So we'll see. We'll see what that looks like. Also, these damn cowboy hat ads come up in my feed because that stupid ass show we did with Regil and Saied, where they were talking about LA Dodger hats that were shaped like cowboy hats. Ever since that conversation, because everybody listens to everything you say now, this shit pops up in my feed all the time. I hate you guys so damn much. I almost want to buy a cowboy hat because now I'm preconditioned to want a cowboy hat every time it comes up. This is bullshit. Let's get back in the sectors. All right, so commercial real estate refinancing risk is improving. We've seen some incremental interest rate, but this is really just broad market rally, picking them back up. Let's go to the mega caps. This is going to be gummies and lollies, kids. You ready? Whammy. Apple, Microsoft, Nvidia, Amazon, and Alphabet all up. I don't have Facebook here. I probably should, but man, this is not a Mag 7 chart, kids. This is a mega cap tech leader stock. I like Apple. I think they're going to crush it. Microsoft sucks ass. You know my feeling on that. Nvidia, Amazon, Alphabet. Oh, cool. They're cool. But Microsoft, you suck. Innovate, man. Make something new. That's all I'm going to say about that. All right. Let's go to consumer spending. Of course. Home Depot, 5.24%. Come on. Walmart, Target for classy, Costco, Home Depot, Dollar General, all up. This is where the money goes when the consumers are spending, and I think that's the appropriate knock here. Industrials, wow. Caterpillar, Deere, General Electric, Union Pacific. Energy sector is going to be interesting. Yeah, there you go. This is the craziest part about a broad market rally. You're getting a broad market rally, but everybody who benefited from high oil prices is getting the little flick, little one of these right in the ding ding, and they're not able to carry themselves up. Schlumberger or Schlumberger, if you like it, you could say Schlumberger if you want. They're doing okay, and they've always been kind of an outlier here, which is why I included them in this mix. But of course, the natural logical question is, Chris, where is oil at? Of course, it's down. It's down big. How big, you say? 94.40 for what used to be literally $20 higher, frankly. It's down $18.50 just today alone. I want to say 18.63. Yeah, there you go. So you're down a whole hell of a lot since the morning, which is why you're seeing the energy sector down. This is all, of course, on the swing of optimism. If you're a long-term person and you want to bet on there being some benefit here, this is a great wager to make. I think at some point in time, the energy sector is going to come back to reality. At least you should have made it already. This particular point in the day, I think it's that money's already been played. But yeah, you've seen that sector rally before. You've seen it rally back, and you've seen it rally down. When everybody else is down because of this geopolitical construct, these bad boys go up. And when everybody else is rallying in this space, these bad boys go down, down, down. So expect that to continue. The defensive positions, they're not going to be holding up great. They're okay. Duke Energy, meh, because it's energy related. Nextera Energy's kind of flat in the day. Johnson & Johnson, Coca-Cola, and Procter & Gamble, all okay. I do think the new GLP-1's coming out, retatrutide in particular, which has a more anabolic effect. You don't lose as much muscle mass while you're getting skinnier and your metabolism slow to the GLP-1 is going to be very provocative. I think everyone's going to be even more on that than they currently are on the current series of GLP-1s over time. And as they develop pill forms, you're going to see some benefit there. So yeah, the sectors are popping, and it's a really fascinating time to be watching the markets. I don't like the volatility. I like, I don't want a bipolar situation in the markets, but that is where we are at, kids, and that's what we're going to have to look at. Let's go to the socials. Introducing Claude managed agents. Every goddamn day I go to social media, there's a new Claude announcement. Come on, Claude. Damn, guys. Wow. Right? You need to build and deploy agents at scale. It pairs with an agent harness tuned for performance with production infrastructure, so you can go from prototype to launch in days. Now in public beta on the Claude platform. God, these guys are just crushing it. Benjamin Netanyahu rejects President Trump's ceasefire and says the war will continue against Iran at any time he chooses. Wow. I wonder if that's true or if that's wow. I mean, doesn't seem to have 6 fingers in this one. Does he? No. Well, let's look at somebody a little more reliable than random ass X page. Kobisi letter. Perplexity's revenue has reportedly surged 50% in 1 month. I believe that to be true. After shifting into AI agents per Financial Times, let's look at the chart. You know I'm a big fan of the chart work. Yeah. Crushing it over there, Google's. Perplexity revenue growth, estimated ARR. You know, if you're running that division, somebody's going to get a bonus soon. Wow. Perplexity hits 450 million ARR, and suddenly my search history feels so last year. I love the comment section. Let's see here. Perplexity hitting 450 million ARR proves that enterprises are willing to pay a massive premium for tasks over text. Yeah. I want to get something done, not read about it. AI agents are becoming the new frontier. Yeah, you should watch The Higher Standard. We've been on that frontier, kids. It's not new news. It's just news, right? I haven't talked to the comments in a while. What's going on here? Yo, what up? Let's see here. I gotta really keep up to date with the comments a little more. Full week Higher Standard. Billy is revolting and wanting a pay raise. Yeah, Billy does want a pay raise. Good example. See, this is why I check the comments. It's funny. All right, let's see what else we got here on the news side of things. Bloomberg terminal costs 27,000. Y2 does the same job for $20 a month. No, it doesn't. I've seen a lot of these come up on social media as of late, where people suggest you can get a Bloomberg type. You can get a look and aesthetic of a Bloomberg terminal, which is effectively what ours kind of is, but tailored to us. But you don't get that without the data and the infrastructure that they have, and just to get the data access they have in real time is very expensive. I pay I want to say $200 a month just for my AI feed of data from one source. That doesn't include the other sources like news, like options trading. So I think that's a very, very unfair narrative that people have been kind of spinning out. Best summary of America I have seen. Oh, this ought to be good. This is somebody random. Foldable iPhone engineering. Yeah, I'm not going to watch that. Too random an account. This one I did watch. This is in White House says President Trump rejected Iran's 10-point plan and threw it in the garbage. Yeah, that was said. Anthropic just killed thousands of startups. I love the meme game. It's just so good. The Claude managed agents. Yeah, the managed agents thing is interesting. If you got a way that AI can manage the agents on its own, it'd be fascinating. But my AI currently already can launch Claude code from the terminal. So if you have, for example, my AI, agentic AI on a machine, right? He's running on a Mac Mini. He can go out to the Mac Mini, open up the terminal, which is basically that DOS prompt looking thing, and launch Claude code, and then tell Claude what he wants done in the terminal. And there's also this thing called MCP, right? MCP allows Claude code to look at and interact with your screen. So he has his own virtual screen, which he can see at any point in time. So he can look at that and he can diagnose any aesthetic problems, which makes my life a whole lot easier, right? He can go, okay, did this fix that problem? No, it didn't. That's effectively a small version of managing several agents that way, right? So my AI will manage the Claude code agent, and then they'll have a conversation back and forth. It's also very fucking expensive, and nobody ever talks about those API calls, but that's a problem. New favorite clip from Japanese news just dropped. Well, now I gotta watch it. Okay, come on. What is that? What does this even mean? I have a feeling this is going to be something very inappropriate, but let's go for it anyway, shall we? Let's see here. Here we go. Come on, play, dude.
Trump always chickens out. Trump.
I did not see that coming. I probably should have watched it first. That's good. Too good. All right, let's see what else we got here. Mercedes-Benz condo development in Miami scrambles for financing after foreclosure lawsuit. Yeah, a lot of the construction stuff's been really interesting as of late. Some of these MSAs are going to have market rents in home prices coming in home prices, but rents coming down, and because of that, you're going to see some of the values of these properties continue to deteriorate. So if you're delivering new construction to the market and you have an estimated top line revenue figure for your property, which is going to drive your valuation for it, that's coming down 10 to 15% in some markets, and you've seen that across the country, particularly those building high-end luxury properties in the Sun Belt regions, which includes Florida. So yeah, it doesn't surprise me at all to see some consternation in those spaces. Now, workforce housing, rent control in place, I think it's got a different paradigm, but time will tell. I'm not Nostradamus, but it'll be interesting. We have seen this movie before in housing, except this time it's much worse. Darth Powell has been all over this and really, really angry as of late, which shout out to you, Darth Powell. Worse demographics, inflationary environment without a depression, true. AI destroying the jobs market, true, but unrealized by the FOMC currently, which is strange to have their sentiment on as of late. That's true. We aren't there yet. The cycle is affordability. I agree with that. Let's see what the chart work says here. Real monthly principal interest index, Case-Shiller home price index adjusted for inflation and mortgage rates, 1990 baseline. Yeah. Okay, I get it. I get what you're saying here, kids. That's bad. So it's basically telling you that the monthly P&I for properties is near all-time high in the last 40 years in certain MSAs. This is at least Phoenix included here. Let's see what else we got here. Let's read the whole thing, right? Why not? Housing bubbles typically do not pop. Rather, prices tend to deflate slowly in real terms. Correct. Over several years, historically, real estate prices display strong persistence and are sticky downward. Yes, they are. Because you have to understand this is where people live, and where they live is not an easy thing to change. So it's typically the last part of the economic ecosystem that is impacted meaningfully. Plus, we got lagging indicators on housing and everything else. The data infrastructure is poor, to say the least. Sellers want a close to recent sales in their neighborhood, and buyers, sensing pricing, are declining, will wait for even lower prices. So, yes, the behavioral economics are real here. This means real estate markets do not clear immediately, and what we usually observe is a drop in transactional volumes, which we are seeing currently, which I think is probably the reason why he provided this. Transactional volumes across the country are down, meaningfully down. Even though prices tend to deflate slowly, they can still drop significantly over time. And I expect that's what we should see. 15, 16 years artificial interest rate deflation, almost 20, frankly. Prolonged periods of economic prosperity, 7 to 10 years, peak to peak, trough to trough. Covered this in the last episode. It should come as no surprise that it'll take longer for these housing prices to correct. That is still better than a market crash, right? I know that a lot of people online are like, oh, we need to have a crash. We need to have a crash is coming. Okay, I get that you want this correction in valuation, but isn't a prolonged, painful correction better than a short, really, really painful correction? I guess there's an opinion at that point. Even though prices tend to deflate slowly, they can still drop significantly over time. On the following graph are the nominal price declines for 3 busts: Los Angeles in the early 90s, San Antonio in the mid 80s, and the oil patch bust. And Hartford, Connecticut, starting in 1989. These peaks of all 3 housing booms are aligned on the left, and the relative price declines are plotted by the quarter after quarter local markets price peak. Yeah, I think, look, that's all statistically sound. I think that's all good data. Arizona has the 3rd worst housing market in the country, only doing better than Florida and Texas. Median days in the market, 65.8. Listings with price drops about 29.2%. Okay, yeah, there you go. Financial Times, Iran will demand that, this is from 6 hours ago, shipping containers pay tolls in cryptocurrency for laden oil tankers passing through the Strait of Hormuz, which has yet to happen yet, as I told you earlier in the show, as it seeks to retain control over the passage through the key waterway during the 2-week ceasefire. I honestly feel like there's just, okay, we got Iran, whose positioning is they want more than that it seems like the White House is willing to give them. At least that's Carolyn Levitt's suggestion this morning did. We've gone from really harsh rhetoric yesterday into a bit of a softer tone today. And frankly, some of the rhetoric was inappropriate. But again, maybe there was some intention there that we don't understand, or some reason to be that aggressive, whatever. But you've got the U.S., which wants one thing, Iran, which clearly wants something very different for the outcome here. And then you've got now Israel, who was at least at some point supporting us in this endeavor, or us supporting them, who knows, who have signaled a very opposite sentiment to a ceasefire at this particular juncture, and seemingly no one has given us close proximity to resolution. So while ceasefire talks are going on, I don't know that I've seen anything that gives me the belief that something like, I don't know, this should be happening. Strange, but it is where we are. So, yeah. All right, let's get back into a couple more articles here before I call it a wrap today. The Iranian regime has officially announced the closure of the Strait of Hormuz 1 hour ago, citing massive Israeli attacks inside Lebanon per AP. And again, if you recall, part of the narrative originally was that they wanted all the attacks on Lebanon to stop, which was an interesting ad, I thought, from a geopolitical conflict. The U.S. housing markets, where $1 million listings are standard. Yeah, I should be clear about that. I do get critical of the housing market, and there's a lot of real estate professionals who watch the show. Look, I'm not saying that you can't make money. I'm not saying that you shouldn't make money. I'm just saying that the dynamic landscape is changing. Those real estate agents who have put their value proposition of service in building an actual client base as opposed to transactional base, they're going to do well. Housing is regional. Some markets are doing sensationally. Some markets are not doing sensationally. You can still make money in a not sensational market. You just got to be heavy into the relationships, right? That's what moves your business. Don't listen to the NAR's bullshit. Clients, consumers, they don't want to hear that rhetoric, that lobbyists spin. Oh, if rates would just go down, we would all. You need to acknowledge that home prices are too high, okay? If you own a home and you're selling it, that's good for you. That's your client, great. Value that. If you don't own a home, you're trying to buy a home, or you're trying to buy a home and you just sold yours and everything's too expensive, you got to be a little bit more emotional, sympathetic to that. All right, that's the show, kids. What else we got out here? Who's on the Instagrams? Who's out there? Regil, you're Nostradamus. You are Christradamus. I actually go Nostradam Chris is probably the way to properly do that. But I'm an arrogant prick, and we don't need to add more arrogance to the situation. Let's see what else we got here on the stream here. I haven't checked the comments in a while. Yeah, I think we're mellow on today. Look, I got to get some work done today. It's been a long couple of weeks of getting a bunch of nuanced details knocked out. I got people coming to the office here in about 2 minutes. I apologize for a little bit of a late start today. I was just trying to catch all the news coming into it, but we're leaving the day on synthetic volatility being kind of meh, which I don't think really lines up with the VIX drop. I'm going to double check this again. I've had some real tough times with our synthetic volatility. We're seeing the market run back down a little bit. Maybe this is a response. Maybe this is a response to the headline we just saw on CNBC about Iran's saying that they violated the ceasefire. I don't know. Maybe it's the market just stabilizing a little bit, but we're still in a healthy bull run, but we're not in a full broad rally like we were earlier. So I think that's probably to be expected here. The headlines from AI are still the same. Nothing meaningfully changed there. So again, I think this is just behavioral economics playing out, man. People are really, really hopeful that things will change, and they're trying to capture the dollars in the front end. But you know what? Shout out to you guys. Good for you for being optimism. I wish I shared that at this particular juncture in time. Me, I'm reserved, and I'm betting. I'm betting on inflation coming in hotter on Friday. We will be around on the live show, and I want to get your thoughts on tomorrow's show. If you like it, we're going to do more. If you don't like it, I'm still going to do more. Friday is the first proof of concept for our alpha model. I got some work to do on that as well later in the evening. So hopefully you guys like what you're seeing so far. It's taken a lot of work to get there. And honestly, there's still a lot more to do. Love you. Mean it. Thanks for tuning in, everybody. Till next time. Bye.